Hello everyone, welcome to my channel. Today I wanted to go into Brunswick Corporation and talk a bit about their stock because I think it's at a really good price to buy right now and I think I'm going to be adding to my position. But I think showing you what it is and introducing you to the company is what I want to start with. But by the end of this, we should know, or you should know, sort of a bit more on what the fair value for them is and at what price we can expect the stock to reach within a few years based on certain mathematical estimates. So, beginning with Brunswick, going on to the company overview and what they are, obviously you can pause and read at certain points, but essentially they're in this recreational marine market in the boat industry. So their passion is what they say sets them apart, and they have a lot of partnerships with leading universities, so they have lots of research available, and they can see they're a massive company, lots and lots of employees, and their operations are spread across 29 different countries. So they do have more than just that one market in the US. They are spread across, getting their revenues from multiple areas. However, the US is 69% of their revenue, so it is a very big chunk. And these are sort of their net sales over time and their highlights around what their market is. You can see that their net sales have gone up nicely from 2020 to 2021. Obviously, we can't see 2022 here, but you can see additionally this increases across both parts and accessories, and in the boat section. It's not just specifically for one area of their market. You can see they're growing across multiple areas. Now, what this is interesting with the business acceleration, you can see what their sort of forward-looking outlook is, and they think they're in a unique position where they can capture value from new and diverse participation models, and they want to make it more accessible. So they don't just want it to be sort of for the richest of the rich only. They do want to make it more accessible, and I think that will open up a bit of a new market to them. But that's just an overview of what they are and what they do. But I want to go into a few things which really make this stock stand out to me. So here's tip ranks. You can see here analyst rating consensus, 10 ratings, 10 buy, 0 hold, 0 sell, and you can see here the lowest price target is $88. Now the current price is $73.28, so that's a big jump up of, I don't know, around 20% ish to $88, and that's to the lowest price target. See, the average is around 103 and the highest is at 120, but that is really strong signs. That is exactly what you want to see, where even the lowest of the estimates is way better than where it currently sits. Additionally, you can look at the stock analysis and you can see it's at a 9 smart score, which is really strong and shows really good signs. Their trading view page here, we look at the financials, everything really is moving in the right direction. So their dividends, you can see historically they're increasing pretty much year on year. Every year, just consistently, they're upgrading it a little and giving everyone a little bit more each year. So that's great. You can see in their statements that their assets are increasing pretty much year on year. They did have a slight drop in 2019, but aside from that, going up each year. And you can see this in the graphs here, the assets and liabilities, they are growing as a company, and they're improving their total equity each year as well, pretty much. Again, this 2019, they did have that slight drop, but they're back up to a high now. Additionally, I think it's really good to see their earnings pretty much consistent growth from 2014, consistently growing. Did have that blip in 2019, and then they're back up in 2020, back up in 2021, and you can see 2022 forecast of 2025, they're expected to continue that growth in their earnings, and they're expected to continue the growth in revenue as well, which is exactly what you want to see. And also, which I think is good to look at, is the cash flow. Even though the cash from operating activities is a bit lower this year, this is to do with this change in working capital. You can see that they've lost 200 million in a change in other asset and liabilities. So this isn't going to be a consistent minus 200 million that they're going to lose every year. You can see this is just a sort of a blip, which will mean that this change in working capital, even though it's at minus 400 million over the trailing 12 months, that's not going to typically stay like that. The funds from operations are what you really want to look at in terms of how much they're generating, and you can see this is increasing pretty much year on year at a nice rate, and they're still at a higher amount now than they ever have been at the funds from operations, which I think is really good to see. And lastly, what I want to show you on here is just their price graph over time. You can see since 2012 really steadily growing and growing and growing. Did have the blip during the COVID crisis, bounced probably too high back, which is why they're now down again now. And I think even though they're down quite a bit over the last couple of weeks, this just brings a really nice discount price to pick it up at, which I am looking at right now in terms of adding to my own portfolio. So you can see really nice steady growth and really nice forecasted growth long time as well, over long term, sorry. So lastly, I wanted to bring you to my personal spreadsheet, which says the values that we can pick it up at a buy at a good value. So on here, everything in yellow are the values which I've inputted. Obviously, some of these can be changed. I've gone for a PE ratio of 11. It's never been that low in any year before. If I bring up the statistics again here, you can see right now 9.58, but previously before that 13.31 is the lowest we've ever seen in terms of the price to earnings ratio. So I think 11 is on that conservative side, and it's still bringing a fair value of 86, which is really good to see. And additionally, this is with 5% earnings growth rate, even though the 5-year analyst estimate is 15%, and the half analyst growth rate is 7.5, and my realistic growth rate, based on the calculation, which I've shown many times before, but I can show again quickly, realistic growth rate, you can see, once this loads, you can see here, this is how I've calculated it. If you'd like to read this, you can pause it and read, but following this formula, this is how much they can realistically expect to grow by, and that is sitting at 13.25%. So I think that 5% earnings growth in itself is pretty conservative. So to still get an 86 value with a conservative PE ratio estimate and a conservative earnings growth, I think is really good to see, which is why this is really tempting. You can see I've lowered the share dilution as well to -2%. The share dilution over since 2017, they've gone from 91 million shares to 76 million shares, which is a share dilution of -3.4% each year. But I've lowered this to -2, again, just to be conservative, and we're still coming in really well on these estimates. And the revenue growth rate, even because the price to sales isn't as overly important, I haven't actually lowered this massively. This is pretty much in line with what they've expected. So you can see they're expected to go from 7 billion to 8.96 billion, and in our estimates we're going from 7 billion to 8.95 in the same year in 2025. So basically in line with what the estimates are for the revenue growth rate, and that puts you at a price to sales ratio of 20% upside on fair value. So that's again really good to see, and there's no obvious errors or things or anything that's really screaming out as a whoa, we need to watch out for that. The one thing that I have done is I've increased this cash flow quite a bit. I've gone for 717, and the reason I've done that, as you can see, the current cash flow is a lot lower. It's actually at 379.5, but their funds from operations is 817, and typically on average this change in working capital is very rarely, aside from 2021, it's very rarely over that -100 million mark. So I've gone pretty much 100 under where it currently is. I have gone 100 under where it currently is, and I think that's fair for the operating cash flow because we can't expect to see that high change in working capital each year. So that is why I've gone for this, and I put a 7% cash flow growth rate in. As you can see, it's pretty much increasing at a higher value than that. It can become a bit difficult because of the cash from operating activities being up and down a bit, but if you look at the funds from operations, this is steadily growing at quite a good rate, and you can see it's really at the highest it's ever been right now. That's exactly what you want to see. If I just take these graphs away, just the funds from operations, you can see it dropped a bit in 2018, but it's flying again and back up in 2021 to a really high amount. So that's exactly what you want to see, and you can see that puts the cash flow fair ratio, or fair value, sorry, at 81.63. So all of these fair values have a nice upside to them. Plus, you can see that, again, I showed you that it was a strong buy on tip ranks, but also here you can see the analyst rating, strong buy, and they've got a 102.73 1-year price target, which is obviously a massive, massive upside. So this is something that I'm thinking of adding to. I want to pick up more. I do already have some, but I want to buy more at this discount price. I think it's fallen quite a bit recently. But is this something that you're interested in? Let me know. And if there are any other stocks that you'd like me to have a look at, and if you think you're not too sure on them and you want just another opinion on if they're any good or not, then let me know in the comments and I'll look into them. But that's it for now. Let me know if you're interested in Brunswick, and yeah, I'll speak to you soon.